Hi, everyone. Thank you for joining us today on this Medicaid Monday. As Beth said, it is our 11th one, which is kind of hard to believe, but we are in November. Although the temperature outside probably made you think a little bit more of it being closer to winter than any other time. I had to scrape my windows pretty heavily this morning. But it's very nice to have everybody joining us today. So on the screen before you, just in case this is your first time being with us, this is our team of attorneys. We are Pierre O'Connor and Strauss. We are a full-service elder law firm located in Latham. We also have a full-time office in New York City, but we see clients all over the place from Ronkonkoma, Garden City, Hudson, up north to Lake Placid, out west to Utica. So if you have people in New York who could be of use of our services, there's a good chance that we cover the area that you're looking for as long as they're in New York. So previously we've done a lot of topics on Medicaid Monday dealing with Medicaid, right? We have all 10 previous topics now on the screen, where we start with going through the numbers. We talked about qualifying. We talked about the new NIA process. We talked about trusts. We've talked about pooled trusts. We've talked about nursing home, right? We've talked about what happens if you're denied. We've talked about recertifications. We've talked about planning for people with disabilities. We've talked about the immediate needs program. And then we talked about consumer directed personal assistance just last month. So of course, now we'll pivot to talk about, well, what if Medicaid actually isn't for you? Or how do you creatively approach a situation where maybe funds are short and you need Medicaid? So rather than continuing to have lawyers just talk to you the whole time, we've actually asked some other speakers to join us today. I'm very privileged to have them both here with me. They're some of my favorite people professionally to deal with. I've known both of them for quite some time. So as we get to their pieces, we'll bring them into the fold here too, with another Frank and then Bob Vandy from one of our insurance friends. So we're going to talk quickly about just a numbers refresher, just talking about kind of what it takes to get on Medicaid. We're going to breeze through this because those slides are just available in just about every other webinar in the series. And then we're going to bring on Frank Melia to talk about using home equity to your advantage. And then once Frank is done, we'll bring on Bob Vandy to talk about long-term care insurance and what the marketplace is looking like these days for insurance. So quickly, right, to get on Medicaid, you have to be asset and income qualified. So again, these are not good numbers. They are not high numbers. But so if you're a single person, if you want help in your house, you need to have $1,697 or less of monthly income and $30,182 of assets. If you're a couple, right, we can't just double those numbers. So it goes up to $2,288 for a group of two people in the house for income purposes. And then your asset limit goes all the way up to $40,821. So if you have questions specifically on income, about resources, certainly go back and look at our previous programs. But with that, right, we're going to go now. I'm going to ask Frank to unmute and to turn on his camera. So we'll be joined by Frank Melia of Contour Mortgage. He is a division manager. He's the know-it-all guy when it comes to talking about home equity and how to access home equity to care for or to help with long-term care costs. So Frank, I believe you have slide control. So I'm actually going to just stop talking. I'm going to throw the program over to you, and I'm going to take some notes. And if I have any questions as we go, I'll be sure to jump in. But by all means, why don't you take it from here?
Thank you, Frank. Good morning, everybody. I've been in this elder care arena, I'll call it, for the last 15 years. So just like Pierre O'Connor and Strauss, we sit down with a lot of families in the New York area, regarding keeping their parents or keeping them and their spouse in their home. So I'm going to cover a bunch of areas that I've had conversations with family members in the New York area. And then Bob's going to finish our webinar today talking about the long-term care policy side. I don't think I have control. No, I do. Sorry. Okay. What we're going to start with today is, these are just these are statistics. These are what, I really want the audience and everyone attending today to understand that, there are different ways to fund in-home care. There are different ways to fund care for ourselves and our loved ones. And it's a combination, like Frank just mentioned. There's income. Obviously, people have Social Security, pension, work income. So obviously, income can be a source to fund a lot of our long-term and short-term care needs. Home equity is something that I specialize in. So I'm here just to educate everyone in New York State about how they can use their home equity to their advantage in a tax-advantaged way to maybe pay for some of that care, as well as long-term care insurance, which Bob's going to cover thoroughly. But people should look into long-term care policies. And I do sit down with a lot of families, and sometimes they have long-term care policies, but there's a shortage. The long-term care policy may cover a certain amount of a daily benefit and a monthly benefit, and there's a gap. What I mean by gap is, from the cost of care per month and the benefit with some of these policies. So I'm going to cover some of those options so everyone gets a good idea of what options we have in New York State. Assisted living, which is not obviously in-home care, but since COVID or post-COVID, there have been some incidences where families want to keep their family members in their home. But Medicaid does cover long-term care, obviously in facility-based. But some of these statistics that I'm just showing on the screen this morning, people that are over 60 years old, a lot of their wealth is in their home. Housing wealth accounts for probably half of people's median net worth. It's their largest asset in most cases, the families that we all speak to throughout New York State. And we have to come up with creative ways, and we have to, you have to work with people, as I call it, an elder care toolbox. We all have a different role to help all the communities that we all serve. And the financial side with housing wealth is what my specialty is. And, I'm just going to cover this morning areas that we can look at and areas that we can tap into, to cover that gap and to cover, even if one spouse, we'll get families that one spouse may be in a care facility. That's why I use this slide. And then one spouse might be in home and they need in-home care eventually or down the road, so it's good to know what options are available. On the short-term care needs, I call short-term anything that's, you might not, if it's hard to determine what's short-term and what's long-term, in my opinion, because a lot of people that face short-term needs, they turn into long-term needs. But we've sat down with families in the state, and sometimes on a short-term, like if a parent's just in a rehab center and they're going to be coming home and they're not going to need a nurse or they're not going to need a companion or care, there are unsecured loans that are available. These are unsecured loans that are not held against real estate. These are loans that, my bank doesn't offer them. Some banks offer them, but there's a lot of online providers that offer these unsecured loans. And we've had family members, kids, trustees of trusts, or grantors or occupants, the parents, we'll say, that live in the home, apply for these unsecured loans. They're short-term, they're fixed rates, and the money is pretty accessible pretty quickly. We've also had families look at home equity lines of credit. It may not be advantageous, or it may not work with the parent or the person that needs the care to take out the home equity line of credit. But I've had families and conversations where the children have taken out a home equity line of credit on their home, to pay for their parents' care, whether it be short-term. This also, like I said, can turn into long-term care. But the child takes out a home equity line of credit. If you do, and you have siblings, I find it best to always communicate with your siblings and let your siblings know how much you're taking out of your home or the equity you're accessing in your home, so everyone's on the same page, so there's no issues in the future. Bridge loans kind of exist. A bridge loan is just when you're bridging the gap. Sometimes we'll have a family member go into a care facility, or one family member stay in the home, or they want to downsize, or they want to sell that home, move into a child's home, do a dormer or an extension, or downsize and buy a smaller, more accessible property. Bridge loans are just financing that could get those people into that home, and we do have some accesses for that. On the long-term care needs side, obviously, like I said, Bob's going to cover the long-term care policy very thoroughly this morning, and it's important to have long-term care insurance. But some people don't have it. Some people procrastinated. They didn't take it, or they were uninsurable, or they just didn't feel they needed it. So HELOCs, again, you can take out a home equity line of credit. There's a home equity conversion mortgage, which I'm going to spend a few moments on today, which is the reverse mortgage loan program. A lot of people have a lot of different ideas and misconceptions about how reverse mortgages work, and is it good for me? Is it bad for my family? So there are different ways that we can access a home equity conversion mortgage. Obviously, people can take required minimum distributions from their pensions and their IRAs, or tap into their portfolio. If a family has investments, I'm not saying to spend down your investments because it is your retirement, but it is accessible. It's liquid cash that you can possibly use to pay for long-term or short-term care. Can someone move my slides? Up, up, up. There we go. Thank you. The home equity conversion mortgage. This is the question I get the most of before, during webinars, after webinars. A home equity conversion mortgage is the reverse mortgage program. Okay, I'll go through it very quickly because we're limited on time. This program started back in the Reagan administration. So it came out in the 80s. Didn't really get a lot of, not that it wasn't popular. It was just that, home values were not that as high as they are today. So back in the 80s, a lot of people didn't look at their home as an equity source or a source to tap into for certain things. It's come a long way since the 80s. You have to own your home. It has to be a 1 to 4 family home. We can do condominiums. We can also do co-ops downstate in the New York metropolitan area. A reverse mortgage is based on the value of your home. So if you bought a home for $40,000, $50,000, and now it's worth $300,000, $400,000, you have a lot of appreciation. You have a lot of equity in that home. So it's based on the youngest age. If we have husband and wife or whoever owns the home, the banks will take the youngest age of the borrowers and the market value of the home and the present interest rates on these loans. That's what calculates how much you get. You can take it as monthly income if you're on Medicaid, so you don't violate any Medicaid rules. Our bank is friendly with irrevocable trusts, with life estates. So, not every bank or every credit union understands how to interpret and get a trust approved or a life estate. But if you do planning with Pierre O'Connor and Strauss and you move your home into different types of structures, like I said, with trusts or life estates, speak to a professional that understands that. Our bank understands them very well, so we can always come up with a strategy to implement these programs. There's a lot of safeguards with reverse mortgages. There's counseling involved, which means before you can even move forward and look at the equity in your home, to tap into that line of credit, you have to sit through a phone interview. It's a counseling call. There are also some places that'll do them face-to-face. The government and HUD, which regulates these programs, just wants the borrowers, you can have your family members on the call. They really just want you to speak to a third party, not necessarily a banker or a credit union representative that offers these programs, just to get a good understanding of how these programs work. They'll go through the numbers, we'll give you an illustration on the market value, how much you have access to, and you can ask any questions. The purpose of the call is also to make sure that you understand that you're borrowing money and you're not under duress. I've been doing this for 25 years, and, there is fraud and there is people that pry on our senior population, which is a shame. It's not the banks or the credit unions that offer these programs, but the counseling call wants to just make sure that you understand, and no one in your family is making you do this. You understand what you're getting into, and you understand that you're borrowing money. In 2014, this program changed dramatically. Prior to 2014, you didn't need a credit score. You didn't need income, and everyone kind of got the same amount of access to the equity. A lot of that changed when the 2000 and 2007 and 8 financial crisis hit and real estate markets dropped dramatically. So in 2014, in my opinion, was a game changer for this program. We have to look at your income. We have to look at your credit. We have to make sure that if you utilize a line of credit with a reverse mortgage program and you use the entire thing to pay for this home care that you're looking into, or care in a facility for your parent or a spouse, that you can still afford the property. What I mean by that is you can afford the real estate taxes, you can afford the homeowner's insurance, the flood insurance, and maybe any HOA fees that might be through your organization. Okay. We can also protect non-borrowing spouses. We do find some families in New York State, a wife might have inherited the property and never put her husband on title. We can still protect the spouse. So in New York State, we protect, and the state protects a spouse that might not be on title. It's called a non-borrowing spouse issue. And move the slide, please. We also can what's called a life expectancy set aside, which just means if you choose to, because as we age, sometimes it becomes not cumbersome, but people have to pay their real estate taxes, people have to pay their insurance premiums on the home. So we can offer what's called a life expectancy set aside and pay that for you. It's drawn from the line of credit, but the bank can take the responsibility for you to make it easier on you and pay those taxes and insurance when they come due through the line of credit. It's a non-recourse loan, which means it's only collateralized with the real estate, not going after heirs. Your children will never owe money on this property, even if you use all of the line of credit. There's no prepayment penalties with reverse mortgages, so sometimes people do look at this as a short-term care need. I like to look at it as a long-term, meaning you shouldn't have to do another mortgage after you do a reverse mortgage. But if the unique circumstances that are in your family you need this loan program, you can take it out for short-term and then sell the property if your parents will eventually go into a facility. And just to know there's no prepayment penalties. So you're not going to be penalized to pay this loan off soon. As I said, and I'll wrap this up, we can use any type of ownership, from individual to trust to life estate. And at this point, I'd like to turn this over back to Frank and turn it over to Bob, so Bob can inform us all about how long-term care policies can help us as well.
Well, thank you very much, Frank. I always feel like every time that we speak, I always learn new stuff from you. But I just want to point out just, one of the things that makes Frank and the people on his team such a valuable resource to people like us is because Frank and his team will readily lend to a trust. I know you did say that. I just want to make sure that we kind of bring that point home, because a lot of what we do is we do a lot of trust planning. And then unfortunately, when people get into financial binds at times, sometimes they'll approach their local banker to see if they have some lending options, similar to the ones that you talked about, but they aren't always comfortable lending to trusts. And then we have to talk about breaking up the trust, blowing up the trust, undoing the trust. And that's not usually why we're doing the planning in the first place. We want the trust in place to protect the assets. So knowing that they can have the assets remain in trust and still do the lending options that you spoke about is one of the nice selling points of working with somebody like Frank and his team. So Frank, again, thank you for joining us today. I'm going to ask you just to stay with us because we may have questions at the end. But yeah, so Bob Vandy now, I'm going to ask to kind of jump up. I believe, Bob, you have slide control. So if you want to try to arrow to your slides, you certainly can get going on the insured side of things. So instead of looking at things from the home equity side, where that's typically a very valuable asset that people have, we also work with people like Bob and his team over at Advisors Insurance Brokers to talk about, well, if you don't have like the desire to get Medicaid, well, then you're typically faced with a situation where you have other sources of funding for that long-term care, whether it's privately out of your pocket, but most people cannot afford that for very long. So the other common way that we see people pay for long-term care, but isn't just out of your pocket, is to buy insurance. And there's no better person that I know of to come on to talk about kind of what the marketplace looks like and how insurance can fit into either a Medicaid plan or even a non-Medicaid plan than Mr. Vandy. So Bob, I will hand this over to you. Thank you for being here.
Hey, Frank, thanks a lot. Always great to be with you, and always great to see my good friend Frank Melia as well. So yeah, there really are two general options when it comes to financing long-term care costs. It's public and it's private. And Frank and I are both on that private side of the fence, if you will. The other distinction I would make is that the insurance part of this, regardless of the options that we're going to talk about in the next few minutes, of all the options that you've got, the insurance part of it is the one that requires the most proactivity as opposed to reactivity, meaning you got to have it in place long before you actually need it. It's insurance funding, so you have to qualify medically and financially. And so that's probably the biggest message I would leave for you today in that regard. The next thing, what I want to do is I want to take a kind of a cross-sectional look. So there have been a lot of changes in the long-term care insurance space, both in and outside of the state of New York. We're obviously going to focus on, hey, what's going on here in the state of New York, but there are changes outside of New York as well. And I'm taking a cross-sectional approach. This is as we know it today. We may be having a different conversation 6 months, 1 year, 5 years from now than we are now. But there is some value certainly to taking a look at this and saying, where are we? So really the main options that we have for insurance funding of long-term care costs as of today, we still do have traditional long-term care insurance, which has been the predominant format, if you will, to insure the risk of long-term care, extended chronic care costs. It's been around the longest. It's gone through some changes here recently. We'll talk a little bit more about those. The next one is something that we commonly refer to as linked benefit, and that's a combination, if you will, of a life insurance policy and a long-term care policy kind of melded together. And then the last option is really just life insurance as we've known it for a long time, but with a special rider we often refer to as living benefit rider, which can come in the form of a long-term care rider, sometimes called chronic illness rider, and what have you. So we'll take a look at these, just take a couple of quick minutes. I'm admittedly going to go pretty fast here because I know we have limited time. And when it comes to traditional long-term care insurance, one of your main takeaways is that that's where you're generally going to get the best benefit per premium dollar. In other words, for every dollar that you spend in premium, you're going to maximize the most long-term care insurance benefit from a traditional long-term care insurance product. At the same time, it's a product that if you never need coverage, and sometimes people say, well, gee, what if I never need this? Well, it operates much like auto insurance or homeowners insurance or liability insurance or disability insurance, where if you don't use it, you don't necessarily have anything coming back into your estate at death. Now, we intuitively recognize that, but for people for whom that's a problem, they would like to get something back. You would either have to choose what we call an ROP rider or return of premium rider on the traditional long-term care insurance, or you'd have to look at one of the other options that we're going to look at. Generally speaking, premiums are not guaranteed, and we have seen rate increases on in-force long-term care insurance blocks in our business. Some of you may have heard of that. It's a good news, bad news proposition. It's not great news if you have a policy that's impacted by a rate increase, of course, as I have been. But it is good news from the standpoint of if you don't currently own coverage, the coverage you're purchasing today has most of those factors that contributed to those increased rates built into the rates that we see them today. So there's a big difference between older policies and newer policies relative to the cost and the stability in the rates on a go-forward basis. The last thing here we should mention is something called the New York State Partnership. It has been a strong program in the past, but it didn't get as much market penetration as it should have. And it's basically an asset protection mechanism where the partnership is between the private insurance company, the state Medicaid system, and the insured or the New York State resident. Unfortunately, we don't currently have carriers who are selling policies in that partnership structure. So I'm not going to take more time on that for now. So let's shift gears and talk about linked benefit policies. And what you're buying here is a relatively small death benefit life insurance policy. You're really not buying it for life insurance. The main function for the life insurance is to give something back into my estate, either if I have used some of the benefit or if I've never used any of the benefit. With the options that you have here in New York State, currently, you can either fund these types of products with a single lump sum. We see a lot of people that will take money from old life insurance policies and do what we call a 1035 exchange into these newer policies, or money from a really conservative rainy day fund that people are informally planning to use for long-term care costs, and either put that in a single payment, or there either are 5-year or 10-year annual premium options as well at this time. One of the differences with traditional long-term care insurance, as we alluded to, the premiums are unfortunately not guaranteed. They really can't price traditional long-term care insurance to guarantee those premiums. They're much more stable today than they used to be. But with these linked benefit policies and products, you can actually guarantee the premiums. A lot of people find that very attractive. And then, of course, in addition to the small death benefit that is built into the design, there is an added layer of a very attractive long-term care insurance pool or pot of money as well. I'll give you an example of that here momentarily. And then you also have, once again, sorry for the acronym, but ROP stands for return of premium. That one of the other benefits with these linked benefit policies is if you decide 5 years, 10 years after you buy it, hey, I really don't need this thing, I don't want this anymore, you can walk away with traditional life insurance, and with most of the life insurance options I'll talk about in a moment, you're really not going to get anything back. However, with these linked benefit products, depending on when you decided to walk away, if you did, not many people do, but if you did, you'd get anywhere from 80%, 85% up of your premium back if you did decide to walk away. So that can be a nice benefit as well. Finally, we've got our life insurance with what we call living benefit riders. And these are your life insurance policies that have been around for a long time, and they come under different labels or types: universal life, whole life, which a lot of you may be familiar with, even term life. There's one carrier here in the state of New York that will write these living benefit riders on a term insurance policy. So that's pretty interesting. Now, in these designs, these death benefits can be accelerated. So the way that I get funds out of my insurance policy to pay for my long-term extended care, chronic care costs is by accelerating or getting the death benefit early. I have to meet certain criteria to qualify, like I would with a traditional long-term care insurance policy, but I can use my death benefits early in a very tax-favored fashion. These are sometimes referred to as long-term care riders. They're also sometimes referred to as chronic illness riders, and there are some minor differences between the two. Typically, these policies, with the exception of the whole life, with the universal life policies and the term life policies for sure, these are not built to build cash value. They're really designed to minimize any cash value that's built in there to maximize the amount of death benefit, because that's where the benefits are coming from to pay for long-term care or chronic illness. And with these products, the premiums are generally guaranteed as well. The death benefit with these products, since that's where the source of the long-term care benefit is from, the death benefits are actually much larger compared with those linked benefit policies. So at death, if I never used it for long-term care, the amount of death benefit with these policies would be the greatest of the three that we looked at. So when you think about it, you might draw the conclusion which one's best. I would have to suggest to you it really does depend. And I'm going to share just a quick hypothetical here. You know, in terms of the costs of these various products, I just took a quick example of a 60-year-old female with standard underwriting. You may, if you're applying, you may qualify for a better rate or not so good a rate. I'm not putting an inflation benefit on here, and I'll tell you why in just a second. And then we've got a 90-day, what we refer to as an elimination period, or EP. That's like a deductible. In other words, how much do I have to pay out of pocket before my policy kicks in? Well, if I'm looking at a linked benefit product, that's the one that you can fund with one premium, or I can fund it over 5 or 10 years. I'm going to try to compare these as closely as I can. So let's say I wanted to build up a pot of money that had $300,000 in it, that if I need care, I can go to my policy and get it. Well, with the linked benefit, the way this design works, you could take, of the $300,000, you could take $62.50 a month over a 4-year period. The death benefit in that product would be $150,000, and the amount of premium that it would take to purchase this, if you wanted to pay a single premium, would be $96,894, or you could spread that out over, say, a 10-year period. And with the product that's in New York, you can currently do that and just divide by 10. Most other products, you'd have to add a modal factor or a fee on top of that. So in this example, in the bottom row here, I wanted to show, well, okay, if I went on claim at age 80, which is about the average age that people do go on claim for long-term care, how much premium would I have paid in? Well, with this linked benefit product, I would have paid just that $96,894, whether I paid in a single sum or over the 10 years. In the middle column, we've got our life insurance with the long-term care rider. Same $300,000 benefit amount, that's coming from the total death benefit that I can accelerate to pay for long-term care. And that typically could be paid at $6,000 a month over 50 months. The death benefit in this instance is that $300,000, so you can see how that's much higher than the other options. The premium for that option is a bit higher because that's a lifetime premium at $72.15 per year. So if I add $72.15 a year over a 20-year period, this 60-year-old, if she went on claim at age 80, would have paid in $144,300. And then on the far right, you can see a traditional long-term care product. That's the same $300,000 long-term care benefit, payable at $6,000 a month for a little over 4 years, so about the same 50 months as the middle column. In this instance, we did not specifically put a death benefit on there, but there is an option where you can add a return of premium rider, and you can see I've got 2 different premiums here listed, so you can see what the impact would be. If I'm not so worried about that death benefit or that return of premium, the annual premium for that product would be just over $3,000 for this 60-year-old female. If I did want to add that return of premium, so if I don't use the policy, I want to get something back at death, having come back into my estate, it'd be about an additional $1,000. It'd be just over $4,000 a year. And those are lifetime premiums as well. Once again, if we go out to age 80 in the bottom right there, we go out to age 80, how much would I have paid if I went on claim at age 80? If I did not have the return of premium, then I would only have paid in about $61,000. If I did have the return of premium, I would have paid in about $81,000. So you can see there the point that I was making earlier, which policy design gives me the most pure long-term care benefit for the premium that I would pay. You can see how the traditional long-term care insurance does that pretty effectively. On the other hand, no death benefit, generally speaking, except for the return of premium. And those premiums, as I mentioned, are not guaranteed, although I think we can presume that they're much more stable today than they've been in the past. So in terms of determining which one might be best, premium and affordability is a huge factor, right? I could look at the life insurance at $7,215 a year, or the linked benefit at $9,200 a year, $9,800 a year. But if I can't afford that, if I don't have the cash outlay, it kind of takes that option off the consideration list for me. So as I mentioned, traditional long-term care, most cost effective in that regard. Do I care about that death benefit? Am I buying this for the insurance it's intended for, which is long-term care insurance coverage? If so, maybe I'm not so worried about the death benefit. I'm looking for the most cost-effective coverage, and that's why I'm buying it, like my homeowners or my auto or my liability coverage. Am I worried about potential future rate increases? I think the answer is everybody is. The question is, how worried am I? And that level of concern will help the decision-making in terms of, which one's going to be best. I didn't include inflation coverage in any of the options that we looked at for the simple fact that most of those life insurance options in those first two columns we looked at, there is no inflation inherent in those. So that would be extra. You'd have to pay extra to have an additional amount of benefit to keep pace with inflation over time. And you can certainly add that, but just for simplicity in comparing benefits per premiums, I just left that off here, but we can certainly give other examples there. And then to wrap up, I think you want to consider, as Frank was alluding to, and Frank Hemming and Frank Melia, do I want to be Medicaid or private pay? There are reasons for both. There are other, just so for broad awareness, there are non-insurance options out there. There's something called True Freedom, which is basically a discounted home care program, which is a non-insurance program that is available. We find those are particularly attractive for those who can't qualify medically for an insurance option. Next, just in general terms, and we are out of time, so I'm not going to get into this in detail. There's no point because it doesn't exist yet anyway. But there was proposed in 2022 something called the Long-Term Care Trust Act in the state of New York. There are other states looking at these programs. That would be a payroll tax, a mandated payroll tax that if it went through, New Yorkers would have to pay, and there would be at least some minimal level of long-term care, or really more akin to a short-term care benefit. It's not out there, but we may hear more about it in 2024, so we'll have to stay tuned on that. Life settlements are also available as a potential financing mechanism, and that's where I have an older life insurance policy. Maybe it's blowing up, meaning, the cash value, it's running out. I haven't adequately funded it and it's going to lapse. I don't want it to lapse. Can I sell that policy to a third party for a lump sum or even a stream of payments? And the answer is yes, sometimes. So that was all I had. There's my contact info really quick. Frank, I'll turn it back over to you. Really appreciate the opportunity to be with everybody today.
Yeah, no, thank you, Bob. Again, like if you have long-term care insurance, there's few people that I know the products or the options as well as Bob. So thank you very much for coming on. Bob, I do have a very quick question for you. This is probably not the smartest question when it comes to insurance, but I think in general, just people in my practice have generally been confused about this. So when they're paying premiums, right? Is it generally speaking a safe thing to say for most of your products that when they go on claim, they no longer have to pay any premium in at that point?
In general, that's true, Frank. There are some nuances with the life insurance products with the riders. Certain carriers or products may require the premium to continue. I would say more often than not, that's not necessary. Once you've met the qualification criteria to have the benefit paid out for long-term care or chronic illness, as it's sometimes called, generally speaking, premiums would cease.
Okay, I would say that in my head, that generally seems to be how it generally works, but I just wanted to clarify since we've got you here with us. So we're past our time, so I don't want to spend any more time other than to say thank you to everyone for joining us today.